Well, so our topic today is compound interest. So far, what we discussed is a simple interest. Now we focus on the compounding. As we discuss, when we are saying compound interest, it means interest on interest. So when you invest one or you borrow for a single period, and after that, if you continue for the second period, so what is going to happen for the second period, your principal become the interest and the principal of the first period, and that's what we call it as compounding. Now let's start with this. What we're going to talk in this topic: compound interest fundamentals. Like we will talk about the fundamentals of compound interest, determining the future value based on the compounding, and determining the present value based on the compounding as well. So equivalent payments determine the interest rate, in equivalent and effective interest rates, and determining the number of compounding. So here the important point to note is that we are talking here for a single payment. So single payment means that we want to pay after the term or after the contract of investment or borrowing in a single payment. Later on, we will talk about annuities. That's the different topic. So there's a difference between compound interest and a simple interest, and that we can see here. Uh, that's a fundamental difference, that principals we have to return in both the cases, or we will get back in both the cases, whether it's a simple interest or a compound interest. So principals are common in this. Time, yes, expressed in units of time such as days, months, or years, whereas in compound interest also expressed the time in a same manner, like expressed as the number of times that interest is calculated. So there is a difference. Like here we are simple interest, we just calculate over whatever the time is, if it is a 1 year, 6 months. But the compounding is a different, that at what time the interest is going to be converted into the account or accrued, and then we charge again for the next period the interest, not only on the principal but also the accrued interest per unit of time, such as days, months, or a year. Interest rate per calculation of interest rate means the per time period. At the end of the transaction time frame, when the interest is placed into account, and with every calculation of interest. So when the account is placed into the account for a compound, every interest payment calculation, and in a simpler at the end of the term. And we see here that the impact of a different interest rates on the compounding. So there is a huge impact. Like if we are considering that we are investing $1,000 for a different interest rates. So if the interest rate is 3% and we keep this money for 25 years, the money is going to be converted into 2,900. But if the interest rate is 15% and we keep this 1,000 for 25 years, then it becomes a 32,908. So it's a huge difference because the compounding effect is going to be applied every year, because an annual rate, and in if the interest rate is small, so the impact is smaller. But if the interest rate is large, like a 15% or a 12%, the impact is very huge. And you can see that where as the interest rate is increasing, the impact is quite different as well. Like for this one, for this one. So a slight difference, like from 20% to 15%, the impact is about double. Yeah, about double. Now, compound interest. So it's very important when we are calculating the compound interest rate, that what interest rate we have to apply, because normally the interest rates are given per year, annual. So IY is, we represent this IY as a per year interest rate, per year interest rate per year, and CY is a compounding per year. How many times we are compounding? It can be a 1 year yearly basis. It can be a semi-annually, 6 monthly basis. It can be a monthly basis or quarterly basis, 3 monthly or 1 month, or it can be bi-weekly or a weekly, or it can be a daily basis as well. So this is the way that it works. So we have to calculate I first, because in the formula for calculating this future value or the present value with the compounding interest, we need I, and I is important, and it's very important to calculate how I. And in coming all the topics what we're going to discuss, we have to use this I in annuities, in perpetuities. So it's important to understand I here at this point. I is IY, which is a annual rate of interest, divided by CY, which is the number of compounding in a year. Number of compounding in a year. It can be 52. It can be 12. It can be 2. It can be 4. So it varies. It depends. So let's start and see here a question. Calculate the nominal interest rate for the following periodic interest rates. So it's a 0.583% per month and 0.05% per day. For each question, calculate the nominal interest rate IY. So what we want to calculate it IY. So I is given. That's important. I is given. IY we want to calculate it. It's not we want to calculate I. We want to calculate IY. And the time period CY is given like per month or per day, right? So that's the way that we have to do. So let's do the first one and then we will talk about them. So question number 1, the given is I, Y we want to calculate. I is given as 0.583 percent per month, and CY is 12 per month, right? So the formula is saying I is equal to IY over CY. So I is 0.583% is equal to IY, which we want to calculate it, and CY is 12. So IY, if you multiply this 0.83 with 12, we get it 7% compounded monthly. Right? Similarly, we can also do the same way. This is the first part in this question. B part in this question we just directly apply is 0.05% is equal to IY over 365. So IY is equal to 18.25%. That's our way of calculating IY or I. So this practice makes us a good understanding of the nominal interest rate. Compound per year, calculate the compound frequency for the following nominal and periodic interest rates. So we want to find out CY. So again, the same formula, but what is given? Nominal interest rate is given, IY is given, periodic interest rate is 3, I is 3, and what is CY? So let's start. This is question number 2 and the A part. So what we can do is nominal interest rate is given, IY is given as 6%, and periodic interest rate is 3%, which is I, 3%. We want to find out CY. In the second question as well, IY, so I just want to undo it. How much is the IY? 9%, and I is 2.25%, and CY we want to find it out. So what is the formula is saying? I is equal to IY, which is 6% over CY. So we know that IY is our 3%. So CY is equal to 2. It's a semi-annually, because CY is 2, so we can say it's a semi-annually. And if we want to apply here as well, 2.25 is equal to 9 over Cy. So Cy is 9 by 2.25. So it's going to be 4. So 4 means compounded quarterly. Cy, not C only, Cy, quarterly. Right? So it's simple. It's very easy. It's not difficult. Now, determining the future value. For future value, what we need to know that how many payments are going to made. It's not because if the payments are number of compounding period, not the payments, number of compound. The payment is single, but the number of compounding, and for which we need the value of n. How many times the amount is going to be compounded. So how do we get this n? We need to know Cy, which we already know that it's a frequency, that's a time compounding. Cy is a compounding per year because it's a single payment. So later on we will talk about some other variable as well, that's a Py, but here we are Cy. Cy is a number of compounding and multiply by the number of years. Compounding in a year, Cy is what we calculated in these two questions. Cy is 2 compounding semi-annually, Cy is 4 compounding 4 times annually, multiply by the number of years if we are keeping for 2 years, 4 years, 10 years, 1 year, so whatever it is. So we can figure it out then. Then we have a formula for future value, and the future value formula is very simple. And this is a simple single payment formula, single payment. Keep it in mind because we're going to use this concept in later on chapters as well. Like partially the concept is single payment and partially the concept is of annuity. So here we have to focus on single payment. So what is the future value? Future value is equal to present value into 1 plus I exponential n. What is I? We already discussed. What is n? We already discussed. Present or future values, one of the value is given, so we can calculate the other one. So here is a question, an example. Making an investment, if you invest 5,000 for 10 years at 9% compounded quarterly, how much money would you have? Calculate the principal and the interest together, which is called the maturity future value. So we can calculate the future value here. It's again the question, the top one. So what we have, so it's a present value, which is 5,000, and the for 10 years, years are 10, and compounded quarterly. So Cy is equal to 4. And how much would you have invest? Now we need to and Iy is 9. Now first of all we have to find out I, which is Iy over Cy. So 9 by 4. 9 by 4 means 2.25%. 9% by 4, 2.25%. In our formula for future value, we have a present value, which is 5,000 into 1 plus I, which is 0.00225. N, now we miss here N. How we calculate N? N is Cy into years. So N is equal to 4 into 10, which is 40. So we have to multiply this exponential of 40. So we take an exponential of 40. So we get it, finally what we get it is we have to, because we invested, so we will get back 12,175.94. That amount we will get back. So this is a future value. 5 years ago, Coast Appliances were supposed to upgrade one of its facilities as at a quoted cost of 48,000. The upgrade was not completed, so Coast Appliance delayed the purchase now. Until now, the construction company that provides the quote indicates that prices rose 6% compounded quarterly for the first 1.5 year and 7% compounded semi-annually for the following 2.5 years and 7.5% compounded monthly for the final year. If Coast Appliances want to perform the upgrade today, what amount of money does it need? 5 years ago. So 5 years ago means 1.5 year, and then 2.5 year. So it becomes 4, and the last 1 year, 1 year is of a 7.5%. So this is a little bit long question. It is simple. It is simple. It's we have to calculate it three different future values, and then we move forward. So first of all, what we have, we want to, this is, we have three different i's. One I is calculate, if we calculate it, because the interest rate is 6%, 6%, 7%, and 7.5%, right? 6% divided by 4, because it's a quarterly basis, and which is 1.5%. The second I we have is for 7%, and it is semi-annually, so we can convert this into 3.5%. And then we have a on a monthly basis, it's a 7.5 divided by 12, so it's going to be 0.625% on monthly basis, right? This is way. N for this is 1.5 year means 6, because it's a quarterly, and is 4 into 1.5 year, so we get it 6. N for this period is 2.5 year, but it's semi-annually, so semi-annually means 2, and a 2.5 year is going to be 5. And N for this one is 1 year and monthly, so 12 into 1 is 12. So these figures are important to remember. Get it? So that's why it's going to be, we're going to calculate first future value, and that is what is the value? 48,000. Yeah, 48,000 into 1 plus I, which is 1.5, so we can write it 1.5 like this, and the compounding period is 6. When we apply this, we get it 52,485.27, or 28, we make it 28. So this is our F1. Now for F2, future value 2, this one is our present value, because we are calculating from that point onward. 1 plus 0.035 exponential 5, and when we calculated this F2, we get it 62,336.04, and then we calculate F3, which is 62,336.04 will be the present value at that time, plus 1.00625 exponential 12, and we get finally the value, which is 67,175.35. So you see, this is our final value, this price required by the constructor to construct this one. Now, now we can apply the present value formula. We just discussed the future value, but now we're going to apply the present value, and the present value formula, if I write it here, the present value formula is, so present value formula very similar to that. What is going to happen? Future value divided by 1 plus I exponential. Simple as that. So Castillo Yeah, Castillo warehouse will need to purchase a new forklift for its warehouse operation 3 years from now. When its new warehouse facility becomes operational, if the price of the new forklift is 38 and Castillo's can invest its money at 7.25% monthly, how much money should it put aside today to achieve a goal? So the future value is 38,000. The rate is 7.25 compounded monthly. What we want to know, present value. So here the question number one again is what is IY? IY is given like 7.25%, and what is given? Future value is given like 38,000. What we want to calculate it? CY is 12 on monthly basis, and years or term for the is 3 years. And what we want to know? We want to know the present value, how much we have to invest. The formula is saying present value is equal to future value divided by 1 plus I exponential n. So if we want to calculate it, I, how do we calculate it? Cy over, Iy over Cy. Iy over Cy. So Iy is 7.25% divided by 12. So what we get it, I is 0.60416%. And n, if we want to find out n, it's a 12 Cy into years 3, so it's going to be 36. Now we can apply the formula. So formula is saying 38,000 divided by 1 plus 0.006046 exponential 36. So when you solve it, you will get it 30,592.06. So if we invest this much right now, so after 3 years we will have a 38,000, so that we can buy a instrument. Sebastian needs to have a 9,200 saved up 3 years from now, so it's a future value. The investment he is considering paying 7% compounded semi-annually, 8% compounded quarterly, and 9% compounded monthly in a successive years. To achieve his goal, how much money does he needs to place into the investment today? So again, this is very similar to the question what we did it before. The first one, this one. Here there are three different rates, CYs are three different for 3 different years. So what we have to do, but one thing we have to be careful here. In the future value, we started from the beginning and then we move on to the future value. But here we have present value, so we have to go backward. So that's the only thing that you have to be careful in this case of in this question. So let's start and see. So first of all, what we have to do, we have to find out I for all the three things. 9% divided by 12, so it's going to be 7.5%, 0.75%. And then in the second case, we have a I, which is 8% semi-annually, so we do quarterly. Quarterly, so we get it 2%. And then we have a I, which is 7% divided by 2, so it's about 3.5% annually. N here is, it is monthly, so we can say it's a 1 year, so 12 into 1 is equal to 12, and 4 here as 4 into 1 is 4, and here n is equal to 1 into 1 is 2 into 1, so 2 into 1 is 2. So here P1 PV1 is 9200 divided by 1 plus 0.0075 exponential 12, so we get it 8410.99. PV2 is 8410.99 divided by 1 plus 0.02 exponential 4, and if we solve it we get it 7770.45, and then we have to apply PV3, which is 7770.45 divided by 1 plus 0.035 exponential 2. So we get it finally 7253.80. So that's our value for this. So what we said, to achieve his goal, how much money does he need to place into investment today? So he has to place 7,200 in order to get 9,200. Now, the fundamental concept of time value of money states that all monies must be brought to the same focal date before any mathematical operation, decision, or equivalencies can be determined, including the following: simple mathematics such as addition or subtraction, deciding whether to adopt alternative financial agreement, or determining if payment streams are equal. So this is an equal payment installments. So let's start and see. So equivalent payments are 24,000 loan at 7% compounded semi-annually requires 3 payments: 1.5 year, 3 year, and 4 year. The first payment is 3,000, and the second payment is 3 times as large as the final payment. Calculate the value of the third and the fourth payment on the loan. So we borrowed 24,000. This is the present value. We have to return into 3 installments. One payment is 1.5 year. After 1.5 year, the second payment is 3 years from now, and the third payment is and 4 years. So first of all we have to find out I. So I is 7% divided by semi-annually divided by 2, so it's going to be 3.5%, right? That's an I. Now we have a 3n values. 1n is semi-annually, and for a 1.5 year, how many semi-annuallys are these? 3, right? So we can use it 3 here. Okay 3, n is 2 into 1.5, so it's going to be 3. And what we want to find out? We want to find out the present value, future value. No, we want to find out present value. Present value of 3,000. What we gonna make it at the time of 1.5 year later? So that's what we want to calculate it, which we call it as a P1. 1 plus 0.035 exponential 3, and the value is going to be 2,705.28117. Then we can calculate the n for the next period, which is 3 years, right? So 2 into 3 is equal to 6, right? Now this time the present value we have to calculate it with the present value is 3x over Why we are putting 3x? Because he's mentioning the first payment is 3,000 and the second payment is 3 times as large as the final payment. So we don't know the final payment, which is x. So we are assuming here that the final payment is x. Now we are making payment plus 0.035 exponential 6. So we get it the value in terms of x, which is 2.4405x. This is P2. If we want to find out PV3, so n for PV3 is 8, right? We calculated it 8 here. Because it's a fourth year, so 2 payments, 4 years, so 8. So PV3 is equal to x, because this is final payment, so we can say x. So 1 plus 0.035 exponential 8 is equal to, how much did we get it? 0.75941x. So we know that it should be equal to 24,000, which is the present value, should be equal to these present values, which is 2705.28117 plus 2.4405x plus 0.75941x. So if we solve for x from this value, so we get it like 6,654.1. So 3x we can find. So the final payment is 6,654.1. However, the middle payment, which is the second payment, is 3 times of this. So we multiply this with the 3 times we can get. So you see what we did here is we try to match future value with the future value and the present value with the present value. So we know the present value of the loan is 24,000, and we make payment 3 payments, which is 3,000, 3x and x. Like these are the 3 payments. We don't know the value of x. So what we do, we want to find out the present values of these payments, what we want to make in the future, for a present value of a 3,000, present value of a 3x, present value of a x, and then we sum up all these 3 and make it equivalent to the present value of the loan, which is 24,000. So by this way we solve this question. Now there is a possibility that if we use the same formula, we can calculate the interest rate as well. And when Sandra borrowed 7,100 from Scans Sanchez, she agreed to reimburse him 8,615 3 years from now, including interest rate compounded quarterly. What interest rate is being charged? So find the nominal quarterly interest rate of IY. So we can figure it out IY with the formula you see here. I is equal to future value divided by present value exponential 1 over n minus 1. So this is what we are getting I. So I is IY over CY. So if we know the I, then we can calculate the IY. So IY is I into CY. So that's what we are doing in the second formula. This is I, this is whole, this very similar, into CY. So we're going to solve this question and then we move on to the next one. So what we can do is, so we have a present value, we have a future value, and we want to, we know what we know. We have a, yeah, CY, CY is equal to 4, and years or term of the loan is, or investment is 3 years. And what is present values? 7,100, and the future value is 8,615.19. What we want to know? We want to know I, or we want to know first I and then IY as well. So how we can do this? The formula is saying We just discussed the formula, like if I write it down once again for your this one, I is equal to future value, I is equal to future value divided by present value exponential 1 by n, 1 by n plus 1 and into cy. No, it's cy we will add up later on, because when we find out iy. So in this case, I is equal to what is future value, which is 8,615 divided by 7,100 exponential 1 by 12 plus 1, right? So if you solve this way, so we get it like I is equal to 0.016249 and IY is equal to 0.016249 into 4 into 4. So by this way, what we get it, 6.5%. Now, equivalent and effective interest rate, if we want to find out the equivalent interest rate, if interest rate is converted, periodic interest rate, the new periodic interest rates are expressed in a compounding frequency and equal to CY new as noted above. So I new is I plus I old into exponential CY old over CY new minus 1. So that's going to give us a equivalent and effective interest rates. Now these are the last 3 questions from this topic. If your investment earns 5.5% compounded monthly, what is an effective rate of interest according to the rule of 72 approximately? How long it take your investment to double its effective rate? So once known, apply the rule of 70, approximately the doubling time, calculate the effective interest rate, and then we have to apply the rule of 72. So here what we are doing, we are changing the compounding. If your investment earns 5.5% compounded monthly, what is the effective rate of interest? So we want to find out the effective rate of interest. IY is given, which is 5.5%, and CY is monthly, which is 12. Old, we call it as old. The CY new, we want to find out effective interest rate in terms of annual, right? So we write it here, I. So I old is going to be 5.5% divided by 12, right? So we get it like 0.4583%. And I knew the formula is saying, which is 1 plus 0.004583 exponential 12 by 1 minus 1. So we get it 0.56408, or we can write it like 5.64%. That's our effective interest rate. So if the effective interest rate is this, at this rate, it takes approximately 12, and if we divide 72 divided by 5.64, we get it around 12 years and 9 months to double the investment, double the investment. So rule of 70 is to say that 72 divided by the interest rate, double the investment. So in 12 years, the investment is going to be double. The next, as you search for a car loan, all banks have quoted your monthly compounded rate, which are typically for car loans, which with the lowest being 8.4. At your last stop, the credit union agent says that by taking out a car loan with them, you may effectively charge 8.65. Should you go with the bank or the credit union? So what we have to find out? We have to find out effective interest rate for. So what we have to do? We have to convert this into the new effective rate, and then we have to compare. So we can see here that our I new is, which is effective interest rate, 8.65%, right? CY old is 12, and CY new is 1. So if we apply 0 0.65, 0. 8 sorry 865 0.0865 into 1 plus I old, which is 0. I old, sorry, I old exponential 12 by 1 minus 1. So if you calculate it, I old, so we get it, I old is equal to 0.006937, and the IY is equal to 8.3249%. So 8.32 old is better. So the offer of 8.65% effective from the credit union is equivalent to 8.3249 compounded monthly. If the low rate from the bank is 8.4% compounded, the credit union offer is better, because this rate is equivalent to what they are offering, right, in terms of compounded monthly. So we can compare this with the compounded monthly rate given by the bank, which is 8.4%. So we reject this offer and we accept the credit union's offer. The last one question is saying you are looking at 3 different investments bearing interest rate of 7.5% compounded semi-annually, 7.7% compounded quarterly, and 7.76% compounded semi-annually. Which equivalent offers the highest rate? Notice that the 2 of the 3 interest rates are compounded semi-annually, while 1 is compounded quarterly. Although you can convert all the 3 to effective rates, it is easier to convert. So the first one is compounded semi-annually and quarterly and semi-annually. So we can compare this semi-annually and semi-annually directly because they are equal. So we can see that 7.76 is better than as compared to the rest. So what we do, we only convert this quarterly rate into semi-annual rate, and then we see that which one is higher, because the rest of the 2 are in semi-annual terms. So let's start. What we have is IY is 7.7%, which is semi-annual quarterly basis, right? So what is CY old? CY old is 4, and CY new is 2. And now we can apply the formula for I old is equal to 7.7% divided by 4, which is 1.925%. And now we have to find out I new with this, and which is 1 plus 0.01925 exponential 4 divided by 2 minus 1. So we get it 0.038870. And when we find out the IY, so we get IY is equal to 7.7741%. So the first offer we already know from the question is 7.75. The second offer for family is 7.76, and this offer is effectively 7.77. So what we do, we see that this is the best option. The option which is in quarterly terms, if we convert it into semi-annually and then we compare all the three semi-annually rates, so this is the best because one is 7.75, the other one is 7.76, and this is 7.77. So this is the best one. So by this way, we finish this chapter, which we want to discuss compounding interest with a single payment. Uh, so stay tuned, and we will discuss the other topics as well. Bye bye.